Inflation is here and we all know it. The Fed has been trying to keep it under control for a while, but now, with different anti-inflationary policies, one of which hedge fund manager Michael Burry just discovered to be false. Burry, after discovering the inaccuracies in the Fed's policies, has basically called it a fraud, a liar, and an economy-stimulating addict in his fresh set of allegations. According to him, the Federal Reserve failed to do exactly what it said it would. So what exactly happened? Today we will look at what the implications of the Fed's promises are, what the implications of its failure to keep that promises are, and the reasons the Fed has given for its failure. If you like our cutting-edge investment content, curated by professionals with decades of investing experience, remember to subscribe to our channel and join in on our alerts so you never miss our new content. Michael Burry is a big name in the finance world. He's an investor, hedge fund manager, and founder of Scion Capital. Michael James Burry is best known to some of us from 2007 when he predicted the US subprime mortgage crisis, and from the huge profits he made from that singular bet. That singular bet made him so popular that it got him immortalized in the book, The Big Short, written by Michael Lewis. The book was a huge hit, and it was later adapted into a movie also called The Big Short, where he was played by Christian Bale. Michael Burry made headlines again, and this time, it's not for a prediction. It's for calling the Fed a liar and a drug addict. While that might sound like a crazy or bold allegation, Burry's claims are backed up with irrefutable evidence. In a now deleted tweet, the hedge fund manager said, "Drugs are hard to kick." And of course he was referring to the Fed's uncontrollable urge to keep stimulating the economy. He continued, Fed was supposed to sell $30 billion treasuries and $17.5 billion mortgage-backed securities per month starting June 1. This was pointed at the fact that the Fed only sold $10 billion out of the $30 billion worth of treasuries it promised it would sell. And, in a more drastic move, the Fed didn't sell $17.5 billion worth of mortgage-backed securities like it vowed to do. It bought $3 billion more mortgage-backed securities. The Fed, through its chairperson, Jerome Powell, has declared that in an effort to reduce and eventually end the fast-spreading inflation, it would reduce its balance sheet, as well as hiking interest rates and other quantitative tightening policies. But Burry is not buying it. According to him, their quantitative tightening is yet to work. He went on to blast the Fed for repeating mistakes and ignoring history, especially what happened during the pandemic. Back then, the Fed's effort to aggressively stimulate the economy sparked an inflation, and yet it keeps doing the same thing now. This kind of behavior is junkie behavior, and it's what Burry meant with his "drugs are hard to kick" tweet. In addition to calling the Fed a junkie and a liar, Michael Burry basically called the Fed a fraud. According to him, the Fed wasn't really aiming at reducing inflation. He believes that the Fed's policies, especially its quantitative tightening policies, was only implemented so that it would have the freedom to cut rates while expanding its balance sheet should equities and consumer spending collapse. Burry, in another tweet, said that all the Fed cares about is reloading their monetary bazooka, and that its serial half-point hike policies and the quantitative tightening are only for getting elevation before the inevitable drop in stocks and the consumer spending. He didn't stop there. Burry also went all out to say that investors like himself and others have totally lost faith in the Fed ever since its mishandling of the global financial crisis, coupled with its decision to slash rates 3 times in 2019, a time when the economy was on a good track. He also claimed that the fact that 2 of the Fed's regional presidents had traded individual stocks and other securities in 2020 also worked to that effect. And if you look at it, those are not even the worst things to happen under the Fed's watch. Inflation in the US has reached 40-year record highs, and the 8.5% increase in inflation we saw in March 2022 only proves that things will get worse. Some people have even said that the 8.5 increase in inflation figure is inaccurate. They believe that the true rate is much higher, and that the Fed is only trying to hide how bad things have gotten. According to Peter Schiff, the government's March 2022 inflation rate was reported to be at 8.5% in year-over-year consumer prices. But according to his calculations, March's 2022 year-over-year import prices were much higher at 12.5%, while export prices saw a shocking 18.8% rise. Going by these figures, the real average rise in inflation should be nothing less than 15.65%. So who are we to believe? The Fed has not issued a statement concerning the results of that calculation, but we can't help but wonder, could the Fed be covering up how bad inflation has gotten? It is still unclear. However, with the Feds lying about the sales of treasuries and mortgage-backed securities, it is hard to believe anything they will do exactly as they say at this moment. But sooner or later, we will find out. If you enjoy our modern, cutting-edge investment content curated by professionals with decades of investing experience, then please subscribe and don't forget to join in on our alerts. And while you're at it, check out this popular vid on the screen right now.